Our market master of the day is Nilesh Shah, Managing Director at Kotak Mahindra Asset Management Company. Nilesh, good morning. Great to have you with us here on the program. Thanks very much for your time. Nilesh, you guys were at Kotak have been the first to kind of sound the alarm bells for, the broader markets. And I think so many sort of, at least on the sell side and even on the buy side, have followed since. Almost a bit of a consensus view now that this is the time now, at least for the rest of the year, for large caps. We had Pankaj Tibrewal with us on Friday, and he was making this point that the median stock return for mid-cap and small-cap stocks in the month of September actually turned negative for the first time after a long while. Do you hold on to that kind of line of thinking, Nilesh, that there is more to go here, in terms of either time correction or price correction for that part of the market?
Undoubtedly, yes, Prashant. Today, small and mid caps are expecting 10 out of 10, in terms of performance. And there are dark clouds gathering on horizon. Oil prices are likely to head higher after what happened in Middle East. US interest rates are likely to remain higher for longer. And rural recovery could get impacted because of uneven distribution of monsoon. All these things would not have mattered much if markets were not expecting 10 out of 10 in terms of performance. Obviously, at this point of time, we believe there is more margin of safety in large and larger mid-cap and less margin of safety in smaller mid-caps, small caps and micro caps and mini caps. Normally, the valuation should decline as we move lower on the market cap curve. Unfortunately, at this point of time, many of the smaller companies are trading at a higher valuation than larger companies, which is unlikely to sustain for long. The good part is that earnings are also growing at 1.25% a month. So there could be combination of both time and price correction than just price correction.
Nilesh, hi, good morning, and thank you for being on the channel. It's very unfortunate to see the humanitarian crisis that's unfolding in Israel at the moment. But history has taught us that every geopolitical crisis has been one of the best buying opportunities for retail investors. Should one buy the dip this time around as well if things escalate further?
Undoubtedly, Sonia, India is a longer-term growth story, and our earnings, at least for the foreseeable future, are expected to grow anywhere between 1% a month to 1.5% a month. That's growth rate of anywhere between 12 to 18%, depending upon what kind of portfolio you have picked up. As long as this earnings growth trajectory continues to remain, I think every correction is an opportunity to buy. Apart from earnings growth, we also have to focus on two things. One, governance standard. Today, Indian governance standards are more comparable to Western world and far better than emerging market peers. We get premium valuation because our governance standards are at a premium. And third thing which we should market to the world is our green commitment. Many of our emerging market peers are not part of COP26 declaration. Many of the developed markets are not on its way to achieve COP26 commitment. India is one of the few countries in the world which will achieve its COP26 commitment, and we continue to remain the lowest per capita carbon emitter in the world. This 3G of growth, governance, and green is something which will keep investors focused on India, and hence every correction is a great opportunity to buy.
Hi, Nilesh. Good morning. You termed the RBI policy at a couple-day kind of policy. They're watching the pitch, they said, and it's turning. They'll play every ball on merit. Tell us more about that. What was your reading of the RBI Governor's speech on Friday? And, some part of the street was hoping that we'll see rate cuts. But that's likely to have got pushed back a little bit. Give me your comment on that.
So, Nigel, Kapil Dev could ball, bat, field, and also captain. Yeah. The RBI is also like Kapil Dev, managing rupee, inflation, GDP growth, financial sector stability, and most importantly, government's borrowing program. And hence I compared that this policy is like Kapil Dev policy, tackling everything. They are keeping everything in equilibrium. Now, market was expecting some sort of guidance on how foreign portfolio investors' demand on debt side will be absorbed. We expect about 20 billion plus passive flows and 10 billion plus active flows. That kind of money is going to have an impact on Indian bond market, and markets were looking forward to RBI's guidance on the same. On the other hand, RBI announced open market operations to take away liquidity. And liquidity was turning negative on some days because of GST tax outflows. So this was a bit of a shock to the market, and hence yields have hardened a little bit. But overall, RBI has done a fantastic job in managing conflicting objectives from growth, inflation, rupee, government's borrowing program, and financial sector stability in control. And no wonder RBI Governor got the recognition as the best central banker of the world.
Nilesh, just absolutely well taken, those points. We saw a very large move in bond yields on the 10-year on Friday, almost a 13-14 basis point jump in the India 10-year. And this morning, yields are flat, which means that they're holding on to those levels, about 7.34 or so. Any thoughts on this, and any implications for financials, NBFCs, etc.?
So I do know that in the second half of 24 and first half of 25, yields will come down from whatever level they are today, because one, foreign portfolio investor buying will emerge of about $30 billion plus, and there will be rate cuts by US Fed somewhere in middle of 24. It's the journey from here till middle of 24 which is likely to be choppy, and with little bit of upward bias because of Fed's option of keeping one more rate hike. Now, this will have impact on all those NBFCs and banks which does not have liability mobilization. Any bank which has access to CASA balance and deposit mobilization at a cheaper rate will do well. Any bank or NBFC which does not have access to cheaper cost of funding, they will be in trouble. And we have already seen banks and NBFCs whose deposit mobilization is not strong. They are not participating in this rally. PSU banks by and large have access to rural hinterland, and that has given them tremendous deposit mobilization capability, and that is already reflected into their prices.
All right. By the way, the sell-off has accelerated, so it's getting worse now. The Nifty has given up on that 19,500 mark. The sensex is down over 500 points. So the market has been trading lower since the start, and it's only getting worse as we speak. Nilesh, I wanted your thoughts on IT, because that's the big thing to watch out for. The earnings season kicks off this week with TCS on Wednesday. The narrative is that things are going to improve, and they have improved, right? The worst perhaps is behind us, and that is the kind of commentary that people are expecting. If you just go by what stock prices are doing, what is your own estimate this time around?
So my feeling is that in terms of results, there will be case-specific stories, but overall general disappointment. We haven't seen sales conversion cycle happening at a faster pace. There is some positivity on cost as work from home has moved to office environment, and the bargaining power of employees have come down as recruitment has virtually stopped. I believe over last 2 quarters, there's no net addition to IT workforce, and hence bargaining power of employees have come down. So there is less of a cost pressure, but there is a pressure in terms of volume and in terms of sales cycle. I think market has discounted that the September quarterly results will not be as attractive. Everyone will be interested in knowing what is the future. And this is where we believe companies which will be able to lay a roadmap that by using machine learning and artificial intelligence, they are able to provide cheaper, faster, better solutions to their customers. They will start getting differentiated vis-a-vis other peers. Every IT company is into AI and ML, but they have to prove that they are better than the peers. If companies are able to convince markets on one, sales volume growth, and second, their ability to leverage AI, ML to create faster, cheaper, better solutions for customers, those IT stocks will be outperforming.
Nilesh, a viewer slash, I'm assuming a Kotak unit holder messaged me saying that Kotak has introduced something called a new initiative, a digital card yesterday. And you wanted to know more about it. I mean, briefly, could you explain?
So it's not Kotak Mutual Fund initiative. It's the initiative of professionals in the industry. Deepak Mundra has been leading it, but myself, Navneet Munot, Anil Singhvi and Shailesh Lodha have come together as a mentor. Essentially, we are trying to protect environment in a very, very small way. We are replacing business cards with a digital card. There is an app called Save Tree VC available on Apple and Android. Anyone can download it for free. It will take care of your business cards. Na card lenge, na card lene denge.
That's wonderful. And congratulations for that initiative. I'll try that out. And so will all of us here at CNBC-TV18. Thank you very much, Nilesh, for that. Appreciate it.